Hey everybody, we are going to talk about an ETF today. It's an S&P 500 ETF, but it's not like the ones that you're probably thinking. Joining me today to talk about it is Dan Kaplinger, a longtime Fool.com contributor, great investor, very knowledgeable about ETFs and indexing and things like that. Before we dive in, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, one of the biggest problems with investing in the S&P 500 right now, and one of the reasons that I don't put more of my money into S&P 500 index funds, is because it's really like you're investing in like 7 or 8 different stocks. A lot of the big companies have really just gotten to the point where they make up a disproportional amount of the index. Think of companies like Nvidia, Microsoft, the Magnificent Seven. If those companies have a bad day, the S&P is going to tank. If they have a great day, it's going to go up. And over the past couple of years, they've gone up more than down, but it's still like you're not really buying 500 stocks when you buy an S&P 500 index fund. If HP Enterprises has a great day, would the Vanguard S&P 500 ETF do anything? No. So we want to talk about one, and it's called an Equal Weight S&P 500 ETF. And Dan, can you kind of just give us the quick overview of what an equal weight fund is and how it works and why you like it?
Yeah, so basically what we're talking about here, Matt, you've got an index. An index has a certain number of constituents in it. The best known index is the S&P 500, so that's the one that we'll be dealing with here today. About 500 different stocks from just about every industry in the market. They're all large cap stocks picked by Standard & Poor's to be representative of the broader U.S. stock market. And the S&P 500 index is what's called market capitalization weighted, which means that if the value of a company is higher than the value of another company, then the percentage weighting of that bigger company is going to be correspondingly larger than the percentage weighting of the smaller company when you look at the asset holdings of the index. And so that's exactly what Matt was talking about. You've seen these Magnificent Seven stocks rise so much in value. Their market capitalizations, in most cases, well over $1 trillion. Now you've got a few north of $3 trillion. Compare that with companies that are still considered large cap stocks, but they have market caps way down to only $40 billion, $50 billion, $100 billion. It doesn't take much math to realize that when you use these market capitalization weighted index fund strategies, you're going to have some stocks that have 10 times, 20 times, 30 times or more the weighting of other companies. And at some point, when you have, like in the environment that we've seen lately, you're just going to have a handful of stocks that make up a huge portion of the overall index. And so what equal weighted indexing is intended to do is to kind of cut that off and to say, look, you had to do something to become part of this index. You had to be one of the 500 most important large cap stocks according to Standard & Poor's. Once you get there, we're going to give you the equal rights to everybody else. We're going to invest as a fund. We're going to invest the same amount of money in the smallest stock in that index as we do in the Nvidias, in the Microsofts, and the Apples. And so as a result of that, you're going to have a different kind of performance because in the market cap weighted ETF, so much of it depends on what happens with those highly weighted mega cap stocks. With the equal weight, it's less dependent on any one given stock. And those smaller companies, when you treat them in aggregate, have a much larger impact on the performance of the whole fund than they would in that market cap weighted fund where they're almost irrelevant to the returns of the fund.
Yeah, and whenever I mention the equal weight S&P 500, a lot of people push back and say, well, won't I underperform the market because these big winners aren't driving my performance anymore? And if you look back just over the past few years, you'd be right. Just a few stats. Over the past 3 years, the equal weight index has underperformed the S&P weighted index by 12 percentage points. Over the past 5 years, by 22 percentage points, and over the past 10 years, by 57 percentage points. But that was a 10-year period when we saw an unprecedented wave of companies becoming mega caps. That's not historically normal. If you zoom out over the past 30 years, the S&P 500 equal weight index has outperformed the weighted version by 360 percentage points. There was a big period. It was stretched from right around the end of the dot-com bubble through the end of the financial crisis, or a few years past the financial crisis, actually, where the smaller components actually outperformed the larger ones of the S&P. In certain types of economic climates, they're more conducive to smaller companies becoming bigger companies, and you see that over the long-term performance. So it does make sense as an investment from a long-term perspective, especially if you think that the Magnificent Seven have had their run, which I'm kind of in that boat at this point. A few years ago, I might have disagreed with this call, but I right now I think it's just it's time for the little guys. A falling rate environment generally favors the smaller half of the S&P 500. Those are the companies that are more likely to pay dividends and rely on debt to fund their operations. The smaller half of the S&P, as opposed to these big companies.
They're often the higher growth companies too, Matt.
That's true.
This is sort of an unusual situation we've been in where those mega cap stocks have found ways to grow that they never have before. Ordinarily, it's these new up-and-coming companies, when they just enter the S&P, that they're able to have such a big difference. But again, in that market cap weighted situation, they have almost no influence until they get big. In the equal weight, they have equal influence even as they are growing.
Right. So if all these companies are growing well, except for the top, that's like an ideal situation for the equal weight. But It does let you kind of share in the benefits. Really interesting one. We'd be doing a disservice if I didn't mention one drawback. The fee is a little bit higher for the equal weight fund, which is totally common for a more specialized ETF like this. And the expense ratio is 0.2%, which I wouldn't call high by any stretch. But compared to like the Vanguard S&P 500 ETF, which is 0.03, it's a little bit higher investment expenses. So you have to take that into consideration. And I mean, another caveat is, NVIDIA and Microsoft, they could double over the next couple of years. It's entirely possible. And in that case, you would miss out probably. You would probably continue to underperform. So pluses and minuses, but I really like this one. Thanks for coming on and talking about it with me, Dan. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.